Great. I'd like to welcome everyone to the holiday edition of what was formerly known as the investment webinar, which is now known as the
Bullish on Business.
Bullish on Business webinar. Of course it is. I'm Drew Watson, your host. John Randall, my co-host, is going to be joining us momentarily. He is, I think, been doing good works in the community on this holiday season. And, of course, we have Jacqueline Jordan, the incomparable one, manning the ones and twos back here at D2 headquarters. We've had a momentous market action since we've last joined you. I'm in share screen mode, which hopefully you'll be seeing, if not now, in just an instant. We had a Fed meeting today. It appears they may raise rates one more time next year than what they're anticipating. And we've had a little bit of the market reaction has been decidedly, initially, I think it was positive, then they didn't like it, then they liked it, and then they didn't like it. It's kind of like the opposite of the old VUL sale, where they want it and they didn't want it, but they wanted it, but they didn't want it, and they wanted it again. So basically, since our last call, we had a lot going on. We've had asset prices, specifically stocks, in the broad market go on a pretty good run. Mainly financials, mainly energy. Those were the leading sectors and were materials. Laggards, healthcare has continued to stutter. Utilities have been under pressure, as have consumer staples. You can see on my screen there's a little bit of green. These are mainly tax-free type funds, which have held up better than their taxable counterparts. But broadly speaking, since election night, interest rates on the 10-year Treasury have gone from about 1.71 to about 2.53. That is almost a 48% increase in about 5 weeks, which is astounding. I think today, for the first time in many a moon, as they used to say, the Fed talked about inflation creeping into the picture. Irregardless of your politics, I think one thing that Trump has accomplished is interest rates have moved up, market rates, since his election, and I think you've seen some wage inflation as well. It had been posited for quite some time that Trump may be an inflationary candidate, especially given wage inflation vis-a-vis his immigration policy. Data coming out of your more southwestern cities in the U.S. had shown since the fall that entry-level jobs that were posted were taking longer to fill, and those business owners were having to pay more money for that same worker. Typically, as you get into your entry-level jobs, what happens is those are the people that spend all of what they make. They don't have the resources to save. It takes all that they make to get by, which that in and of itself is inflationary. And if you're paying those people more money, that's, as the theory goes, inflation, more inflationary than what we've had in other types of scenarios. So I think we've seen two, things happen in about 4 to 5 weeks that have taken 8 years to get here. Bigger concerns, too, what we've had another election in Italy, and it appears this same global wave that brought the Brexit to pass, has brought Trump to the White House, has also made changes to the Italian Constitution. So this is not a one-trick pony. I think this more nationalistic anti-globalization push is something that has been on the books now for a couple of years, and it looks like it has some staying power. What does that mean on the investment front? Well, what does it mean? One, for us, we have been woefully invested in international stocks. So one of the things people will ask us, how are you doing so well? Well, one, we do not have really any international stock exposure to speak of. That is because the real juggernaut here has been the U.S. dollar. So UUP is what we use there. It hit a new high today. The chart here says it, everything that needs to be said. Now, is my picture in their picture too? How do I move this?
Oh, yeah, that's not, you're good.
Okay, well, I want to see the top of it. So basically, this chart has been going pretty good. So this is the U.S. dollar versus other currencies. So the downsides of a strong dollar, the biggest losers are a lot of emerging market economies. First and foremost, because a lot of their debt is priced in dollars. So if you go to bed with a $100,000 mortgage, you may wake up with a $120,000 mortgage. Also, all of the world's commodities are priced in U.S. dollars. So even though we've had dollar strength, you look here at the commodities markets, by and large, and of course I've moved my picture right to where it shouldn't, you see an incredible amount of red here. So as the dollar strengthens, all else being equal, you have a lot of commodities go the other way in price, such as, soybeans were down today, hogs were up, corn's on here somewhere. Jacqueline's helping me. I don't usually use the screen. But basically, if you're a commodity producer priced in dollars, corn was up, 1 cent. It could be a double-edged sword because most of your what you make is going to be, and you can kind of see the action here. What you make is going to be losing value. So it's going to be very, very hard times on the emerging markets. In your more developed markets, it's going to be a hard way to go for your multinational companies to do a lot of business overseas. And that's what we've seen. The rally has really been exaggerated to the upside in your small and mid-cap indexes. The Russell 2000, IWM, as we call it here. It didn't hit a new high today, and it was off about 1.23. But we can kind of see by the charts, it's had a pretty exaggerated move up since the election. So we have exited the international markets, especially the emerging markets, when we have a choice between a large multinational and a more U.S.-centric company. We've erred to the U.S.-centric companies, and when in doubt, we've been piling our cash into that U.S. dollar index, and to this point, things have kind of worked out. It's interesting to note on this page, really the green here in the middle that I'm circling, most of those are tax-free bonds. Those have been abused since the election because they've been hit with the double-edged sword of not only higher interest rates, but also the specter of lower taxes. As Jim Grant put out in this week's episode of the Grant's Interest Rate Observer, and as we have been saying now for about 3 weeks, this is a buying opportunity. What's going on here is even though rates may go down from 39% to 33%, if you can buy some pretty good quality bonds at a discount or buy a term trust at a discount, and a 4% coupon still can become, relatively speaking, about a 5.5% to 6% coupon. Your wealthiest clients who are in wealth preservation mode will very much like that as an option. This morning, that's what I discussed with some of our better clients. I've been doing that now for 2 or 3 weeks. It's something that resonates with them, that this is an opportunity. As we've discussed before in the municipal market, it is very much a sell first, ask questions later market because it's usually made up of unsophisticated individual investors and your other large owners are mutual funds, which typically have to sell to meet redemptions, and banks, which are not the most sophisticated balance sheet managers. And if you need to get an example of that, look at the 2008 and 2009 global recession. So there's probably a big opportunity there in municipal bonds. Other areas that we're looking for opportunities in, I would say, would be tech. Mr. Tech, and I think you know, VGT is kind of a fallback for us. You can see the run's been from 92 to pretty much where it is now. It's a great run. But inside of that, you can kind of find some other areas that haven't participated with the Trump rally. One of those is a little company called Amazon.com. I don't know how many of you are familiar with it on this call, but you can actually buy something on your phone or your computer, and they will send it to your house in a matter of what seems to be minutes. Somehow the market believes that Donald Trump will stop this from happening. Now, if you believe that, you also probably believe he hasn't had any work done under his eyes or on his hair, and that everything on Melania has come just like it did right out of the factory. But be that as it may, the stock's gone from 850 to 768, and election day it hit a low of, I think, just under 720 is where my alert was, and it started kind of rebuilding the dike, so to speak. This is probably one of our top tech picks because of what I said. And of course, I mean, I'm joking. Jacqueline's laughing. Trump can't stop people shopping at home on Amazon any more than anyone could. So look for relative value. We think probably here, even at these exaggerated PEs, Amazon's got a very, very good business model put together, and that's one that's kind of taken off. The area that we also too, you know, as we're looking at things a little bit different, Netflix in the tech sector, this would be an M&A, because one of the things I think that we will see happen with a change in Washington, I think we will get back to what the old timers call animal spirits. This is the old Meyer Rothschild, blood in the streets. I think we'll start seeing some M&A activity, especially in banks, but also across the board. Netflix, I think probably many on this call are familiar with what they do, although I'm not. I don't even have a Netflix account. My children use it quite a bit. It is a very popular distribution method for content. What has started with the AT&T Time Warner merger, which in a way is to get HBO and WTBS Time Warner owned content across the AT&T distribution system, there might be a potential marriage of people such as Netflix and, in my mind, Disney, potentially someone that has a lot of content. I would say it's probably Class A content and a distribution system like Netflix. At the end of the day, all roads will lead to Apple and Google. They are the two cash cows that can pretty much swallow anything out there in the marketplace, with the exception of probably Exxon and Chevron. And there might be an end buyer at the end of the day. I think the more you read of where the economy's going, where technology's going, as it comes to these devices and such, you've got to have some content, and you've got to have a way to deliver it. And I think most of your forward-thinking executives are trying to put together how does that all work. So Disney and Netflix have been two things also kind of the plant the seed, hope it grows type investments that we've been focused on as well. In the alternative space, we've talked about the U.S. dollar, and that's a move that's worked exceedingly well with a new high today. One that hasn't worked so well has been silver. We've been in silver twice this year. The first time was extraordinary. We got just out under the high. Silver and gold had their worst month in quite some time, last month, and this month's not getting any better. It looks like gold may have breached 1,100 an ounce, and no, not quite. Just the ETF did. So I've got an alert set to see when the underlying breaches 1,100. I think you might see some buying come in there. As we stated at the top of the call, we think Trump is inflationary. That ultimately, at the end of the day, would bode well for gold and silver. If your clients are worried about buying something that's at the top of its chart, these two metals, the case could be made that absolutely they are anything far from the top of their chart. The other trade we opened and closed here recently was unleaded gasoline. It had had a tremendous run after the OPEC meeting, and I think Grant closed out somewhere just south of $29, went in around 24. So that's been a pretty good trade. Bigger picture things to think about is one, we've seen softness in the consumer staples. I think a lot of that is where they got their growth in the last 15 years, more than likely has been the emerging markets. So as I said at the intro, any emerging market weakness is a bad news for your consumer staple stocks. And then utilities, they don't like rising interest rates, and it's clear that rates have risen and look like they're going on that trajectory as well. JJ, do we have any comments, questions, feedback?
John should be on now.
Yes, hello.
Hello.
The only comment so far is not a question, but Levent chimed in to say that Trump got a bad deal on the hair job.
Well, I'll tell you what, when I get that age, I want my blonde to, those locks to just go like that. Well, John, welcome aboard. We've kind of done a little bit of an investment review. As we close the year, just a reminder, go through and look at, realized gains and losses. If you have people with gains, this might not be a bad time to sell anything you can at a loss. Keep in mind just the brief sketches that we've had of the Trump tax plan. Here's kind of the three main takeaways. One, both Trump and Paul Ryan, it appears to be on the same page about wanting to have three tax brackets. They're either going to be 12 or 15% to start with, then 25 and 33. The capital gains rate appears it will go to, from where they are now, to half of your ordinary rate. So that would be around 6, 12, 16. Now, here's a key planning point. For those clients of yours who today could be in the 0% tax bracket, that is the 15% bracket or lower, you may want to take gains in this bracket, assuming this loophole goes away. But all thing else being considered, if you have a higher bracketed taxpayer, it may be in their best interest to wait to take gains in January, and certainly you may want to look at ordinary income items in January. The flip side of this is supposedly itemized deductions may be limited to $100,000. So if you have people that have pretty large philanthropic wishes and plans and designs, this year that type of tax break may certainly be worth a lot more than what could come down the road next year. So those are, I think that's some low-hanging fruit. If you on this call have an entity, or you have clients that have flow-through entities, LLCs, S-corps, partnerships, the discussion right now out there, according to Paul Ryan, is to make a flat 25% tax on flow-through income. For some people, that's going to be a tax deduction or a tax break. For other people, it may be a tax increase. But this goes into their plan to simplify the tax code and to make it more even-handed across the board. So that appears to be kind of the low-hanging fruit, the best I can tell from these markets. I think also what is coming, based on Ryan's comments on CNBC, is probably a doubling of the Medicare tax for people that are working, because the excise tax appears is going to be dropped. Medicare is woefully underfunded and is a big-time problem, which politicians have failed to evaluate and address. And so a doubling of that part of our employment taxes would not be a surprise to me. The money has to come from somewhere. And I, for one, just wish, hope they address it head on and get that taken care of. So that's, as far as I can tell, the potential tax changes coming down the road. And also, I think what's discussed is, John, that this will probably be the first thing that they tackle once everybody gets sworn in and they start addressing issues in Washington, D.C. So that's kind of what I have been discussing at this point with our clients, those types of issues, those opportunities, and maybe where the market's got ahead of itself in a few spaces. That's what we've been covering.
Great insights as always, Drew. If you have questions out there, go ahead and find them on the chat box down there, where we'll look for them and answer them as we go. But Drew, with all these changes coming up, I know in January we'll be kind of highlighting your your spreadsheet, changes you're making in your practice. So any highlights looking forward into next year, things that you expect to be different or change?
Well, I mean, yeah, Grant and I have been working on that. I think probably, John, what you're going to see is mostly alternatives. We're going to try to go liquid. We probably will have some changes to the mutual funds that we've been kind of doing more things with, just as the mutual fund industry changes. What we've seen is a big push for transparency from clients. I think as you battle it out with your competitors or the indexers, of course the Dow had a great run because financials have had a great run. So I think, as we get to the close of the year and the other year beginning, what I'm seeing is there's value in being active and addressing the asset management parts of the business head on, because I think clients respect that and they feel like you're earning your fees. But also with the Department of Labor and changes that are, probably going to come down the road in January, I think the onus is going to be on documentation, as well as, and John, we've discussed this, the whys and wherefores of your changes. What we're doing here is not so much a change in how we invest money, but giving ourselves more time between meetings to finish everything as quickly as possible, just post-meeting, and getting it all documented as quickly as possible. I go back to something I said, I think either last month or the month before. Your really wealthy clients expect to be contacted pretty quickly when they have a question or concern within the same day, and they also really, really like it when you reach out to them on a periodic basis, just to let them know that you're looking over things. Other things here that we're going to be doing that kind of tie into the investment spreadsheet. If for those of the advisors on the call that have had difficulty assigning clients to junior members of the team, one of the things that we know works best as a best practice is let that junior member of the team or AFA be the one to go over the portfolio changes and updates with those clients that you want them working with. That helps develop that relationship. It helps immediately to present that relationship in a way that they're working as a team with you, and eventually your necessity, so to speak, to be in the middle of the relationship eventually evaporates. So it's not only, what are we doing differently on the investment themselves, but how are we presenting them to clients, and how much time are we giving ourselves post-meeting to follow up with all the compliance regulations that I think are going to be kind of coming in to what we do. One thing too, John, I will say, as we kind of look at the year in review, is if you want to grow your business, look for EARs, because this Department of Labor thing, as it shakes out, is going to be a huge opportunity. What we know clients like follow-up, especially written follow-up. We are really about the only people in the business that provide that. And from time to time, we're so good at what we do, and we're so ingrained in what we do and how we do it, John, here at Ameriprise and our D2 advisors specifically, we forget there's a whole other world out there that does it differently and not as well. So, make 2017 a year to be on the hunt to make a acquisition and bring some people over to your team, and I think you'll see that bear fruit later on in the year or 2018.
Great idea. I think you're right on. This is a big differentiator. Just doing the basics, the minimum, I think is certainly our industry. I was meeting with some folks yesterday. I had a family visit day. One day a month I spend on my practice seeing clients, and I heard over and over again, gosh, thank you for these different unique topics. We never thought of this. We never thought of that. They walk out the door, they get an emailed summary right away. And I had one person, they're business people, they're retired. They're always interested in our business, always ask things, and they ask things like, why do you do all that stuff? Why do you do the extra? And one thing we talked about is our industry, and that, most advisors, they would have been seen 1 or 2 times 3 years ago when they retired, rolled over all their money, and they probably would never have talked to their advisor again, maybe once. And it's not proactive. The extra effort to send a follow-up note. I mean, that's kind of business 101. So I think you're right, Drew, that the standard of doing business, whether it's I think not so much the Ameriprise way, I think it's more the Ritz-Carlton level experience. So I think that's certainly the things that all of us should be focusing on. How do we enhance that experience of the clients, the families you serve, and how do we continually make them say, wow, more often? So, we're I think that first week of the year we're going to be having the webinar, Drew, around pulling the curtain back on some of the investments, some of the changes that you and Grant are working on. So I know that's always a sought-after one, so everyone should get ready for that. That first Wednesday of the year, we're going to go through what Drew's doing in his practice. I think at this point, if we don't have any questions on the investment side, I think, Drew, let's talk a little bit about our favorite topic and unique different ways to acquire clients. We've been getting a lot of feedback that this is a topic that people really want to hear about on these webinars. We cover lots of different things on them, but always the most popular topic is acquiring new people. How do we do it? What unique ways? What's Drew doing? So, Drew, from a high level, what's some of the best ways that you're seeing to bring people in right now? What's some of your best approaches?
Well, I mean, I think service and what we do differentiates ourselves from our competitors. Also, simplification. So in essence, kind of my focus has been this last quarter and then going into 2017 is, one, how do we keep things simple that's easy to understand, because I think that makes you referable, especially when you can deliver results. I think, two, how do we tie ourselves closer to our top clients and also grow the business at the same time? So we're going to talk about that. And then three, I think you identify what is it that clients don't get and how do you market that? And I kind of tip my hand a little bit, John, and let's start there. So in kind of this, recruiting other advisors and kind of seeing how things work on the other side of the street, what is painfully clear, clients don't get follow-up, they don't get meeting frequency, and they don't get what I would say the amount of detail and specificity that we can deliver to them in each case. So the key that I have been working on is how do we identify the people you want to work with, and I think this is everybody on the call, should have their top 100 list or top 20, their prospect list. You have to have them in Contact Manager, and then how do you drip market on these people as a way that they know that you are doing something different? So one, I think you need to know a little bit about the people, the type of very detailed client-approved articles or white papers or books you find that might be on things that they enjoy doing, and you start sending that to them. But really, a key differentiator for us, John, and we put this in our menu of services, where if you come on board here, you could be an investment-only client, and those range of fees are going to be higher than if you're engaged in financial planning. And then we have 3 levels of planning. One is what we call foundational. It's just kind of your basic, what are the minimum things that have to be done on a Ameriprise financial plan. Then we have comprehensive, which is more of what I would call old planning would be, where you look at more than just the basic information. They're going to get more meetings per year, a little bit more in depth. And then we have what's called integrated. And this is your highest fee for your best clients. And you're integrated in the way we've always been taught is to say, John, I'm going to work with your other professionals, your lawyers, your CPAs, real estate attorneys, whomever else you want us to work with. But we've taken that integration and added something to it. What a client thinks of being integrated is everything's turnkey. And that means that if they don't wake up in the morning, they want everything to be turnkey to get the assets to their heirs. So one of the things we offer in our integrated service is, one, if you have kids, we will work with your kids until they are financially able, on a pro bono basis, until they are able to basically stand on their own and afford our services, as we say. And more importantly, we will work with your parents under the same circumstances. Because, John, what we did is we kind of did a postmortem on our practices. Most of the time for our top people, what we found is we were handling the estate settlements, helping them with the estate settlements of their parents anyway, because they didn't think they had enough money to be clients of ours. Mom's got everything at the bank, or mom had this relationship with an old broker. So we were handling a lot of the estate settlement process ourselves. So why not monetize that in a way to say this is part of our services? So if you have an elderly parent, if you've got a younger child that's just kind of getting started out, that's all part of what we're offering. And what we found is people say, well, God, my gosh, how are you meeting with all these people? Well, guess what? Our top level of service, we're meeting with those people 6 times a year anyway. If one of those meetings is taken up with their kids' issues, which probably it was, or their parents' issues, which probably it was, you have a way to really differentiate yourself, because that's another way that we think that we're showing and delivering really tangible value to their situations. And what we're doing is 2 things. One, on the parent piece, if there's any assets there, you know where they're going to end up. And secondly, we're now getting in front of the issues to work with the parents prior to death settlement, so that we can do things that might benefit our clients or our clients' children. And when we get our clients' children into the mix, what we're doing is really building a moat around the practice. So, in essence, what I've seen as the best practice, if you have a wealthy client that's kind of the middle of the family, so to speak, on the family tree, they may not need the assets that mom has. If you can get mom in the door and talk to her about the benefits of a stretch IRA, make our clients' kids, the lady's grandchildren, the beneficiaries, and guess what? You have a basically pre-made HVC on arrival. That's worked. I think all levels of the family have been very, very much appreciative. They understand we work as a team. That also makes it easier to explain that, hey, we're going to have your kids work with this younger AFA in my office. You know, she's more their age. They might not, you know, they may click better. So in essence, that integrated really means for us is you're getting that client more integrated with the entire team instead of just a one-person relationship. So that's what we found a lot of potential, success with, and we've already had some success, and that's what we've kind of continued. And we've rolled it out, and it's been very well accepted, and we've already had several takers to this point. And parents do not mind giving up a meeting to sit down with their daughter who's just out of college. You know, she's a professional person. You know, she's a young physician or a pharmacist. You know, these kids these days, John, doing a good job. They're making six figures a year right off the bat. And if you can kind of get that harnessed as financial planners, we know what that can end up doing for them. So that's been a really good success for us here in the fourth quarter, and we see it moving forward.
So, Drew, a lot of I think you're right on. A lot of advisors agree with this concept. I think a lot struggle though with what do you do for those the kids? What do you do for those younger younger people? You know, you can't access the Ameriprise tools. So some advisors have struggled. So what exactly are you doing for the the kid out of college, the ones you're helping pro bono? What kind of things do you help them with?
Well, typically it's for us, it's very easy, and I have a guy that does all my financial plans. It's budgeting, looking at debt, help with buying a home or a condo, what benefits they have at work. And these are typically, this isn't comprehensive financial planning, but it's typically single issue, what's the kids facing now that's kind of stopping everything else they don't know anything about. And it's usually 30 minutes. I mean, it's stuff that's not super high level. It's okay, if we're going to buy a house, this is about how much money I think you need to have to put down. Here's what interest rates are. Here's this to do. So basically, it's very, what I would call, for them, it's the most important thing in the world, but for us, if you're a seasoned financial advisor, it's something that's probably 20 minutes or 30 minutes, even as just staff time. And it's just, and then, more than likely you open up a Roth IRA, an account or two, and kind of get them going that way. So I mean, it really helps cement that relationship is what we're seeing. A question we had from Tim Warren. What do you charge for the 3 levels of service? Basically, these are all minimums, and that's the way we have it in our outline, John, what the minimum is. I think whatever the minimum financial planning fee at Ameriprise is $500, $1,000, and $2,500, and it's very clear these are the minimums. Your specific case, your range of fees is going to be higher based on specifics. But those are the minimums that are on the menu of services.
Yeah, great question there. Again, if more questions pop up, go ahead and pop those on there. Drew, on the other end, helping the parents out, great one, because you're right. I mean, there are eventual estate settlements there, and the people you work with are probably going to be inheriting that. I think generationally you see folks in their 80s, 90s. You're right, a lot of money sitting in the bank, not really open to talking about death and planning and things like that. So what have you found with some of those parent clients? Are you preparing more of the estates? Are you capturing assets? How's it been going on that end, working with clients' parents?
Well, and John, we just had a claim this last week. There's a lot of taking over to be agent of record on existing life insurance and annuities. And, I know it's a pain in the rear for people in your office to do that, but hell, that's free money. I mean, there's not it's going to be hard pressed to build a case. Okay, you've had this policy or annuity for all these years. There's no surrender charges. You've got a guaranteed, 4.5% floor. We'll say, look, we'll just see, can we service it? If we can, we'll take over to be the agent of record, make sure the beneficiaries are the ways that they need to be. Also, very much so, look at where they are with, CDs or accounts at other brokerage firms. Bring in, let's verify what your beneficiaries are. Is there a POD on the CD account? Is there an alternative to having it here? Let me talk to you about this thing called the Stretch IRA. We're in a meeting with your own daughter who says she doesn't need the money. Why don't you give it to the grandkids? Funding 529 plans. So that's typically what we've seen. So one, make sure the potential estate settlement issues are taken care of. Titling accounts, beneficial relationships or transfer on deaths on accounts. Also, in a big way, know your state's death taxes. I would say this is probably the biggest, really biggest thing that you can help people, because if they have some what they call Tier 1 beneficiaries in most southern states, there's probably going to be some type of death taxes. New York did have some pretty punitive death taxes as well. So know what those rules are in your locales and where you work, and you'll be able to help in that way. The other thing where we probably do the most work on that, John, is deeds. A lot of the parents of our clients have huge amounts of real estate, farms, homes, etc., still in their name. Know how a life estate deed works. Know what happens on changing the deeds. Go ahead, if they're not going to have a federal estate tax problem or state tax problem, talk to them the benefits of getting stuff appraised with a relatively high value, and then all that is done for them the day that something happens. You've done a tremendous service for their family, and I think 99% of clients realize that. And there's a reason, there's a local auction company. I mean, they send us cookies every Christmas because we probably send them 2 to 3 pretty sizable farm sales a year.
This is really great insight. So for advisors looking to do that, what do you think is their best resource to learn about some of that? I mean, it's just getting with the local attorney to learn the laws real quick, Googling it. I mean, what's the next step for some of the advisors out there?
Go to your lawyer. Who's your lawyer? Say, hey, let me pick your brain. What I'm finding is a lot of my really good clients' parents are woefully ill-prepared to die. They'll laugh. And I say, look, I need to know a little bit more about this. What I'm finding is old deeds. They can't, they don't know where old death certificates are. They don't know, walk me through, how does probate work in our jurisdiction? What are the typical costs? How easy is it for them to change the deed? How easy is it to transfer property? Who has to sign? The lawyers will love to help you because almost all of that is billable hours for them. It would be the equivalent, John, of a lawyer coming into me and say, okay, I need to know the dollar amount and the type of assets you want me to refer to you, what can transfer into this account, in kind. I mean, it's they're helping you, but they, we need to realize is that's money in their back pocket. So they're going to be okay spending time with you. That definitely works and works pretty well.
That's a great one. Really good insight there. So I think that's such a quick, easy one to go to for new clients, new assets right away. I mean, children, parents of your existing clients. I mean, that's an easy one to go to. So is this one of the tools you use here, Drew?
Yeah, what we've done, one of the chief kind of complaints that we've had over time is things are too complicated. And so what we've done is just create something we call the grid. Because at the end of the day, not all, I realize people work with engineers and very technical people, and we have plans that can address that. But most clients just want to know, where's my money coming from? How am I getting it? And what's it look like? So on a non-inflation adjusted basis, what we've done is just kind of created a grid. And on the left-hand side, John, is where's the money coming from? Is it coming from your IRA, your 401k, maybe a pension, husband's Social Security, wife's Social Security, maybe they have after-tax assets, maybe they have Roth assets, but we go through a grid. And in this case, you can kind of see up here, this is where are they going to get their money the first 4 years of retirement, okay? We're going to get it out of basically your 401k plan. That's how much per month. And if you annualize this is about how much in federal taxes you might have and Kentucky taxes. Because almost all of this client's assets are qualified, we've talked to them at length about the benefits of why both of them are alive and they have a generous tax bracket to converting money to a Roth. So that's located in here as well. Then 5 years from now, where's the money going to come from? We're going to reduce some of the IRA withdrawals. We're going to start Social Security at 66 for one for a year, the next year 66 for the other. And here's where, opportunities are. And then this is what happens if they wait even longer and draw Social Security, how much of their money on a non-inflation adjusted basis could come from Social Security. So what we find is we have people that kind of work together, know each other, that the grid, what they bring back to the meetings is the grid. What they talk to each other about is that spreadsheet or the grid, however they refer to it. But we've really gotten a lot of positive feedback on our deliverable by having this just attached to the back of it. And what we know is this is where all the eyes are going in the meetings. It answers pretty much all the questions that they have. We make them obviously more detailed, and this is kind of one we just kind of put together here for the meeting, and we have, formulas and stuff in it. But basically, when I said a lot of times simpler is better, it's easier to explain, easier to show, because what I know is happening is people are showing this. They don't show their statements because they don't want anyone else to know how much money they have. Jacqueline, would you agree that's human nature? But people don't mind saying, well, here's how I'm going to get my paycheck. Because guess what? They work together, they feel like they're all in the same boat. There's no real secrets there. And then so what you get is you get referrals calling in here, oh, hey, what about the Social Security? Or people sending me articles about Social Security's changing. What about my pension? So the grid is a great sales piece too, John, because it's easy for a client to show a prospect this because they're really not giving away any secrets of how wealthy they are.
That's good. Very good.
But there's nobody else doing it. Mm-hmm. So, to me, that's marketing. If you can show a prospect something tangible nobody else does, have the client do it, it doesn't give up any real client, information, that's where we found we've had the most success.
I was just thinking about that. Yeah, go ahead and post questions that we have them. I was just thinking about those tangible things. I was thinking back over the years of doing those very specific ways that people can refer, I think have been some of the most successful. You've talked a lot in these about ways that you can arm clients that are referring, you can arm them to have a very specific conversation with somebody like this. And I think if they have that tangible goods, that Drew saves us money, Drew saves us on taxes, that's something that compels people to get together and want to have a conversation with Drew. So you're right on. This is marketing, arming our best clients, our advocates, with things that they can talk about that are very tangible. I think that's a big secret. Just the fact that, hey, Drew's a great financial advisor doesn't really mean a lot, but things like this is tangible. This is something that people can relate to and grasp, and I think this is exactly where people need to be going. This is really, really great stuff here. So,
and John, I would add to that, the reason why we have that Roth conversion on there and taxes is typically what we have found is that was the least understood. So you'd have some people say, well, I can do that on a spreadsheet. I can put up how much money I'm taking out. Anybody can do that. But by putting a little bit of the technical nuances of our business on there, you're taking it out of their ability to reproduce it and bringing it into the professional realm. Because that's one key thing that we've learned over time is that definitely works best.
Nice stuff. Very exciting. So, any other tips of the trade? Any other final thoughts on client acquisition? What you're really seeing working right now?
Well, I mean, I think you want to accentuate the positive. I think also what I see, John, going on is there's only going to be so many hours in the day for us. As our, even though Trump's in there and he may take some of the regulatory burden off of us, I think, Ameriprise is rightly wanting us, they're probably going to tell us what else they've learned about the DOL we need to be doing in the meetings. So I think it may not be a surprise that for a lot of people that are high achievers, they're almost going to have to slow down to go faster, if that makes sense. So don't get frustrated and have the team to be able to take on those clients you might not necessarily want, but you need because they're part of a bigger client relationship.
Right. Yeah, and I think it's for everyone out there as you're looking at enhancing what we did at D2 Live, your business plans, your marketing plans, and refining where you're going to go for new business. I think it's always been through your existing people as your fastest path to new clients. Go back to your advocates. Arm them with tangible things. Go back to your clients that have elderly parents, helping them prepare for death, have children that could one day be good clients for you and inherit assets from your existing clients. This is easy things to go to that I think a lot of advisors sometimes overlook. A lot of you have been interested in intergenerational planning. This is as easy as it gets. It's a great insight from Drew that don't let the fee be a barrier. Let the value come in. And if you think about your existing clients, how happy will your existing people be that you're helping out their kids? Big concern for them that their kids are going to be okay. So this is great stuff. I love the tangible things to go to arm your advocates to go around and spread and talk about. So really, really great things here. I think it's a very exciting time, and it's certainly a lot of change going on in America, a lot of change going on in our industry, which is okay. It's a good thing. And I think that the opportunity, we all have to remember, it continues to increase. The opportunity to attract new people and new business is going to continue to increase. The number of people retiring continues to increase. The amount of assets moving is going to triple in the next 10 years. The amount of advisors available to help is going to be in half over the next 10 years. So go out there and get some of these people. It's a great endeavor. We heard a little bit at D2 Live about attracting other advisors from other firms to join your practice, a great client acquisition technique. And I think your amount of sellers out there is going to be increasing number of people selling, not only in Ameriprise, but other firms that you can boost your client base that way. So we have a big, exciting year in 2017 here at D2. We've sent out all the event dates next year. We've got a lot of very exciting events, starting with the Becoming Barons events, Breaking Barons event in down in warm Miami Beach. It's going to be at the end of March. It is an investment to be there, but I think that the best advisors are making an investment to learn from the best. I mean, two of the best advisors in the country, you're going to learn from them. We're going to peel back the onion on what they're thinking, what they're doing, what got them to where they were today. You'll learn how to follow that path, how to avoid mistakes or roadblocks that they powered through. So tremendous insights coming at that event. And we're kind of getting the beat on Ameriprise events, what's coming down the line, or maybe some small local things. I think look for maybe after tax season in late April, May, maybe something local. It sounds like the fall is going to be the big time for events. So there's going to be what used to be the Top Performers Conference, the Advisor Growth Conference is going to be in the fall for those doing over $500,000, and I think that's going to sort of take place of the PWA conference this year. But a lot of exciting stuff, but we as always look to provide the most amount of value, change things up here at D2. We got a very exciting webinar lineup for you, lots of new things, new topics, new formats, so get ready. Mark your calendars that first Wednesday of the year at the same bat time, same bat channel. We'll be on and ready to rock and roll. So, Drew, before we close out the year and get ready for 2017, any final thoughts, insights for the D2 group?
Well, I would say just to have your clients prepared. I think probably it would not be strange if Trump's tested internationally early on in his presidency. I think it should be a pretty good year next year, market-wise, but it will be volatile. Just keep your finger on the pulse of your client base and let them know that we have to be prepared to expect anything. Stay diversified and look for the opportunities. And John, from everybody on our side of the table, I'd like to just thank everyone for their continued loyalty and their involvement with D2. Thank you and JJ for putting these on, making it easy for us. And wish everyone a very Merry Christmas and a Happy New Year. God bless you.
Yeah, happy holidays, everyone. We look forward to closing out 2016 strong and the biggest year yet in 2017. So stay bullish, take care, and we'll see you all in a few weeks.
Bye-bye.